These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Welcome to the VIXShield Weekend Podcast. I'm glad you're here, whether you've been with us for years or you're joining us for the very first time this Saturday morning. Pull up a chair, pour something warm. This is the kind of episode we build for the weekend. Slower, deeper, and more reflective than our daily summaries. We take the whole week, lay it out on the table, and figure out what it actually meant. And this particular week, gave us a lot to work with. Here is the story of the week in one sentence. The stock market climbed to record highs. Volatility melted away. Peace talks eased one of the world's most persistent geopolitical tensions, and through all of it, the VIXShield system did exactly what it was designed to do. It stayed in the trade every single day, without hesitation. That's the theme. That's the arc. Now let's build the story properly. For those of you who are new here, welcome. VIXShield is a volatility-focused trading research and education platform. Every week we publish signals, analysis, and educational content centered on defined risk option strategies and volatility management. Our flagship strategies, the EDR, the ALVH, and the theta time shift, are built around one core idea, that understanding volatility gives you an edge that most traders simply never develop. This podcast is one part of that mission, and today we're going to walk through the full week of April 13th through April 17th, 2026. Let's get into it. Monday, April 13th, the S&P 500 opened the week at 6,886. The VIX, the CBOE Volatility Index, which measures the market's implied expectation of near-term volatility, opened at 19 and a tenth. Now 19 is not a panic number, but it's also not a calm number. It sits in that middle zone where the market is alert, where traders are watching headlines carefully, where any surprise can move the needle meaningfully. The 10-day historical volatility, the actual realized volatility of the S&P over the prior 10 sessions, was running at 17.1%. So implied volatility, as measured by the VIX, was running a little above realized. That's a normal relationship. The market tends to price in a little extra fear premium, and on Monday, that premium was modest but present. Tuesday, April 14th, the S&P moved higher, closing at 6,967. The VIX eased slightly to 18 and a third. But here's the interesting thing about Tuesday. The 10-day historical volatility actually jumped. It moved to nearly 16%. That's the backward-looking measure of how much the market actually moved over the prior 10 days, and it was elevated. It told us that the market had been genuinely volatile in the recent past, even as the VIX was starting to drift lower. There was a divergence forming. Realized volatility was still high from recent sessions, but implied volatility was beginning to relax. That divergence is exactly the kind of thing that volatility traders pay attention to. Wednesday, April 15th. The S&P continued its march, 7,023. The VIX dropped to 18 and a fifth, and that 10-day historical volatility, it fell back to 11.8%. That's a significant drop in a single day of data. What that tells you is that a high volatility session from 10 trading days prior rolled off the calculation window, and the recent realized volatility of the market was actually quite low. The gap between implied and realized was widening. The market was pricing in more fear than it was actually experiencing in recent price action. For option sellers, for theta-positive strategies, that kind of environment tends to be constructive. Thursday, April 16th, 7,041 on the S&P, VIX at 17 and 9/10. Historical volatility holding near 12%. The trend was becoming unmistakable. The market was grinding higher, volatility was grinding lower, and the news flow, which we'll get to in a moment, was providing the fuel. Friday, April 17th, the week's closing bell. The S&P 500 settled at 7,126. The VIX closed at 17.5. And the week's final tally was this. The S&P gained 239 points, a gain of 3.5% in a single week. The VIX fell by 1.6 points. Both moves were clean, directional, and consistent across all 5 sessions. Not a single reversal day, not a single false start, just a steady, deliberate climb, higher with volatility steadily declining alongside it. Now, let's talk about what drove all of this, because a market doesn't move nearly 3.5% in a week without a reason. And this week there was a reason, a significant one. The headline that defined this week, the one that sits above all others, was the news of U.S.-Iran peace talks. And I want to spend a moment here because this is more than just a geopolitical footnote. Iran is one of the most significant wild cards in global risk markets. The Middle East carries enormous weight in oil pricing, in global shipping routes, in the broader calculus of geopolitical risk that institutional investors price into their portfolios every single day. When tension in that region flares, when there is uncertainty about conflict, about sanctions, about energy supply, markets price in a risk premium. They get nervous. They buy protection. When that tension eases, when there is credible news of dialogue, of diplomacy, of de-escalation, that risk premium gets unwound. And the unwinding of a geopolitical risk premium looks like this. Stocks go up, oil goes down, and volatility falls. That is exactly what happened this week. Oil prices plunged 11% on the week. 11%. That is an enormous move for a commodity as large and as globally significant as crude oil. And what that move told the market was this. The geopolitical risk premium that had been baked into energy prices was being removed. The market believed, at least in that moment, that the probability of a serious escalation had declined meaningfully. And equity markets responded accordingly. The Nasdaq logged what was reported as its longest winning streak since 1992. 13 consecutive days of gains, tying a historical record. Think about that for a moment. 13 consecutive positive sessions on the Nasdaq. The last time that happened, Bill Clinton was in his first term. The internet was barely a consumer concept, and the S&P 500 was measured in the hundreds, not the thousands. That is how rare this kind of sustained momentum is. The S&P 500 broke to new record highs. The Nasdaq broke to new record highs. Risk appetite, the market's collective willingness to take on risk, surged. And in that environment, volatility sellers were rewarded. Patience was rewarded. Staying in the trade was rewarded. Now, I want to be careful here because this podcast is educational, not a cheerleading exercise. Markets can reverse. Peace talks can stall. Geopolitical situations can deteriorate quickly. The fact that markets rallied on this news does not mean the underlying situation is resolved. It means the market, in its collective wisdom, assigned a higher probability to a better outcome. That probability can change, and when it does, volatility will respond accordingly. We'll be watching. Let's turn now to the volatility picture in more depth, because the VIX number alone only tells part of the story. The VIX closed the week at 17.5, The VXV, that's the 3-month volatility measure, the longer-dated cousin of the VIX, closed at 20.5. The spread between those two numbers, the VXV minus the VIX, was 3 3/100 points. And that spread tells us something important about the shape of the volatility term structure. When longer-dated volatility is priced higher than near-term volatility, when the VXV exceeds the VIX, we call that contango. It's the normal, calm state of the volatility market. It means that traders are more uncertain about what might happen 3 months from now than they are about what might happen in the next 30 days. That's rational. The future is uncertain. And when the market is in contango, it generally means that near-term fear is low, that the market is not bracing for an immediate shock. A spread of 3 points between the VXV and the VIX is what we would describe as strong contango. This is not a borderline reading. This is a clear, unambiguous signal that the volatility market is in a healthy, calm configuration. The term structure is sloping upward in the way it should during periods of relative market stability. Now contrast this with what the term structure looks like during a crisis. When markets are in acute stress, when there's a genuine fear of imminent collapse, the VIX spikes dramatically, often above the VXV. The near-term fear overwhelms the longer-term uncertainty. The term structure inverts. We call that backwardation, and backwardation is the volatility market's version of a red alert. We are not in backwardation. We are in strong contango. The volatility market is telling us that, as of this Friday's close, the near-term outlook is relatively calm. That is a meaningful piece of information for options traders, particularly those running strategies that benefit from elevated implied volatility declining toward realized levels. One more thing worth noting on volatility. The 10-day historical volatility ended the week at 11.8%. The VIX, implied volatility, closed at 17.5. That gap of nearly 6 percentage points is what options traders call the implied realized spread. Implied volatility is pricing in significantly more movement than the market has actually been delivering. For premium sellers, for traders who collect option premium and benefit when the market moves less than feared, that spread is the engine. It is the source of the edge. And this week, that engine was running cleanly. Now let's look beyond stocks and volatility for a moment, because the broader market tells a story too. The U.S. dollar index, the DXY, which measures the dollar's value against a basket of major foreign currencies, closed the week at 98.25. It was essentially flat on the week, down just 0.14 of a point. Now the dollar's behavior matters for risk sentiment in a specific way. A sharply rising dollar often signals a flight to safety. Investors selling riskier assets and moving into the perceived safety of U.S. currency. A declining or stable dollar in a week when stocks are rallying strongly is a constructive sign. It tells you that the rally has breadth, that it's not just a defensive rotation, not just a flight from one asset class to another, but a genuine expansion of risk appetite. The dollar was stable this week. That's a green light for the equity rally's credibility. Bitcoin closed the week at $76,238, up 2.8% on the week. Ethereum closed at $2,359, up 1.5%. Now, I want to be thoughtful about how we interpret crypto here because it's a nuanced relationship. In recent years, Bitcoin and Ethereum have increasingly behaved as risk-on assets. When institutional investors are feeling confident, when risk appetite is high, crypto tends to participate in the rally. When fear spikes and institutions de-risk, crypto often gets sold alongside equities. This week, both Bitcoin and Ethereum moved higher alongside equities. That's consistent with the broader risk-on narrative. It's not a dramatic move in crypto terms. Bitcoin up less than 3% is almost a quiet week by its historical standards. But the direction matters. The fact that crypto moved in the same direction as equities, with the dollar stable and volatility falling, paints a coherent picture. All the risk barometers were pointing the same way this week. That kind of cross-market alignment is worth noting. When the signals are this consistent across asset classes, it tends to be a more reliable signal than when they're mixed. Let's talk about what was happening in the options market this week, because the options flow tells a story beneath the surface of the headline numbers. When the VIX falls from 19.1 to 17.5 over the course of a single week, and when the S&P is simultaneously grinding to new record highs, the options market is going through a specific kind of repricing. Implied volatility, the market's expectation of future movement, is being marked down. Premium is being deflated, and that deflation has winners and losers. The losers are the buyers of options protection, the traders who purchased puts or calls expecting a volatile week and instead got a smooth, steady grind. Their options lost value not just from time decay, but from the compression of implied volatility itself. That double hit, time decay plus volatility compression, is what options buyers face in environments like this. The winners, broadly speaking, were the sellers, the traders who collected premium at the beginning of the week, when the VIX was near 19 and held through a week of steady volatility decline. Their positions benefited from both time decay, the natural erosion of option premium as expiration approaches, and from the compression of implied volatility itself. On the skew side, that's the measure of how much more expensive downside puts are relative to upside calls. We would expect to see skew soften in an environment like this. When the market is rallying and fear is declining, the demand for downside protection eases. The put-call skew tends to flatten. That's consistent with what we observed in the VIX behavior this week. The market was not rushing to buy insurance. It was, if anything, letting existing insurance lapse as the perceived risk declined. Now, none of this means the market has become complacent in a dangerous way. A VIX of 17.5 is not a VIX of 10 or 11. There is still a reasonable level of uncertainty priced into the market. But the direction of travel this week was clear. Less fear, more confidence, lower premiums. And for strategies designed to harvest that premium, this week was a textbook example of the environment those strategies are built for. And that brings us to the heart of this episode, the VIXShield Strategy Review. Let me take a moment to orient our newer listeners here, because this section is really the educational core of what we do. VIXShield operates three primary strategy frameworks. The first is the EDR, the Enhanced Delta Range. The second is the ALVH, the Asymmetric Long Volatility Hedge. And the third is the Theta Time Shift. Each of these strategies has a specific role, a specific market environment where it excels, and a specific set of signals that govern when and how it's deployed. Let's walk through each one in the context of this week. The EDR, the Enhanced Delta Range, is our primary income-generating strategy. It is a defined risk, premium selling approach. Think of it as a structured way to collect option premium in exchange for a defined commitment to a price range. The strategy benefits when the market stays within a predicted range, when implied volatility is elevated relative to realized volatility, and when the term structure is in contango. This week checked every single one of those boxes. The VIXShield signal for the EDR was place every single day this week. Monday, Tuesday, Wednesday, Thursday, Friday. 5 for 5. Not a single hold day. Every session, the signal said, the conditions are right, the setup is favorable, deploy the strategy. And the EDR bias, the directional tilt of the strategy, was forward on every day of the week. Forward bias means the system is leaning slightly bullish, positioning the range to capture upside continuation rather than mean reversion. Given that the market gained nearly 3.5% on the week in a smooth, consistent uptrend, a forward bias was the right call. The modified credit, the premium collected per contract in the EDR setup, held at $1.10 every single day of the week. Now I want to explain what that means in practical terms, because the number itself is less important than what it represents. The modified credit is the adjusted premium income that the strategy generates per contract after accounting for the cost of the defined risk hedge. It represents the net premium you're collecting to take on the obligation of the range. $1.10 consistently across 5 sessions in an environment of falling VIX and rising markets is a solid, consistent result. The consistency is actually the story here. It wasn't one great day and 4 mediocre ones. It wasn't a volatile signal that swung between place and hold. It was 5 clean place signals, 5 consistent forward biases, and 5 identical credit readings. That kind of signal stability is what the EDR is designed to produce in a trending, low volatility environment. The system recognized the conditions early in the week and maintained its conviction through Friday. Now let's talk about the ALVH, the Asymmetric Long Volatility Hedge. This strategy is, in many ways, the philosophical counterpart to the EDR. Where the EDR collects premium and benefits from volatility declining, the ALVH is designed to protect the portfolio when volatility spikes unexpectedly. It's the insurance policy, the hedge, the asymmetric bet that says, I'm not sure exactly when the next volatility shock will come, but I want to be positioned to benefit when it does, without paying an arm and a leg for that protection. In a week like this one, where volatility fell steadily and the market climbed to new record highs, the ALVH is not the star of the show. That's by design. A hedge that performs brilliantly in calm markets isn't much of a hedge. The ALVH's value is realized in the moments when everything else is under stress, and those moments always come. The question is whether you're positioned for them when they do. What this week tells us about the ALVH is actually something important for new listeners to understand. The cost of maintaining the ALVH hedge, the premium you pay for the protection, is partially offset by the income generated by the EDR. That's the design of the system. The EDR funds the hedge protects the EDR. They work together as a system, not as isolated trades. In a week like this, the EDR was generating consistent income, and the cost of maintaining the ALVH hedge was manageable, because the VIX was declining and long volatility positions were losing value at the margin. That's the trade-off. You accept some drag from the hedge in calm weeks, in exchange for meaningful protection when the market turns. And then there's the theta time shift, perhaps the most nuanced of the 3 strategies, and the one that most directly engages with the mechanics of time decay. Theta is the options Greek that measures how much value an option loses with each passing day, all else being equal. Every day that passes, options lose a little bit of their time value. For options buyers, theta is the enemy, the clock ticking against them. For option sellers, theta is the ally, the daily drip of premium income that accrues as time passes and the option moves closer to expiration. The theta time shift strategy is built around the observation that theta decay is not linear, it accelerates. An option that expires in 30 days loses value more slowly than an option that expires in 7 days. As expiration approaches, the rate of time decay increases. The drip becomes a stream, and then a flood. The theta time shift positions the portfolio to capture that accelerating decay, shifting the trade timing to maximize the period of peak theta collection. In a week like this one, 5 consecutive place signals, a VIX declining from 19 to 17.5, the market in strong contango, the theta time shift was operating in its preferred environment. The term structure being in contango matters enormously for this strategy. When the VXV is significantly above the VIX, as it was this week, with a spread of over 3 points, the roll dynamics of volatility products favor the short side. The market is essentially saying that near-term volatility is cheap relative to longer-term uncertainty, and the theta time shift is designed to exploit exactly that relationship. Let me connect all three strategies to the week's narrative one more time, because I think it's worth making this crystal clear for newer listeners. The market opened Monday with the VIX near 19. Not panic, but alert. The EDR said place, forward bias. The system collected premium. As the week unfolded, as the peace talks news spread, as oil crashed, as the Nasdaq logged its historic win streak, the market climbed and volatility fell. Each day the EDR signal remained place. Each day the premium was collected. The term structure stayed in strong contango throughout, supporting the theta time shift mechanics, and the ALVH hedge sat quietly in the portfolio, not needed this week, but ready for the week when it will be. That is how the system is supposed to work, not with heroic calls or dramatic trades, with consistency, with discipline, with a clear-eyed reading of the volatility environment and a systematic response to what that environment is saying. Which brings me to the discipline lesson of the week. And I want to spend a few minutes on this, because I think it's one of the most important things we can talk about, not just for this week, but for how you approach trading as a practice. This week, the VIXShield system generated 5 place signals, 5 consecutive days of the same signal. For some traders, particularly those who are new to systematic approaches, that kind of consistency can actually be unsettling. They start to wonder, is the system too simple? Is it missing something? Should I be doing something different today because today feels different? That impulse, the impulse to override a consistent signal because it feels repetitive, is one of the most dangerous tendencies a trader can develop, and I want to be direct about why. The value of a systematic signal is not that it's always right. No system is always right. The value of a systematic signal is that it removes the daily emotional negotiation from the decision-making process. When the system says place, you place. When the system says hold, you hold. You don't need to reevaluate the entire macro landscape every morning and decide from scratch whether today is a good day to trade. The system has already done that evaluation. Your job is to execute it with discipline. This week, a trader who second-guessed the Monday signal, who said, well, the VIX is at 19, maybe I should wait for more clarity, missed a week where the market gained 3.5% and volatility fell nearly 10%. A trader who held back on Tuesday because the historical volatility reading was elevated missed the Wednesday compression. A trader who waited for a pullback that never came missed the entire move. The market does not wait for you to feel comfortable. It does not pause while you gather your courage. The signal is the signal. And this week, the signal was clear from day one. 5 place signals, 5 forward biases, 5 consistent credit readings. The system was not confused. The system was not hedging. It was saying, with 5 days of conviction, the conditions are right. Place the trade. The discipline lesson this week is this: trust the process when the process is working, and trust the process when it isn't. Because the moment you start selectively following a systematic signal, taking it when you agree with it, and ignoring it when you don't, you no longer have a system. You have a suggestion. and suggestions don't build consistent trading results. Now let's pull back and look at the big picture, the overarching theme of this week in markets. If I had to give this week a title, if I had to capture it in a phrase that a historian of markets might use, I would call it the week the fear premium unwound. Because that's really what happened. For months, markets have been carrying a fear premium, a geopolitical risk premium priced into oil, a volatility risk premium priced into options, a general sense of uncertainty that kept the VIX elevated above where pure economic fundamentals might have placed it. And this week, a meaningful portion of that premium was removed. Not all of it, not permanently, but meaningfully and measurably. Oil fell 11%. That's a fear premium coming out of energy markets. The VIX fell from 19 to 17.5. That's a fear premium coming out of equity volatility. The S&P 500 climbed to new record highs. That's risk appetite returning to equity markets. Bitcoin and Ethereum moved higher alongside stocks. That's risk appetite extending to speculative assets. The dollar was stable. That's the absence of a flight to safety. Every single one of those signals was pointing in the same direction. And when markets align like that, when the signals across asset classes are coherent and consistent, it tends to be a meaningful moment, not necessarily a permanent moment, not necessarily the beginning of a new era, but a meaningful inflection in market sentiment that is worth understanding and worth respecting. Now, what comes next? That's always the question, and I want to be honest with you about the limits of what we can know. The peace talks that fueled this week's rally are still in early stages. Geopolitical situations are inherently unpredictable. The market has priced in a positive outcome. If that outcome materializes, the current levels may be justified. If the talks stall or break down, the risk premium will return, and it will return quickly. The VIX, which has fallen to 17.5, could easily spike back above 20 or 25 on a single adverse headline. That is why the ALVH hedge exists. That is why the system doesn't abandon protection just because the current week is calm. The calm weeks are precisely when the cost of maintaining protection is lowest. And the next spike, whenever it comes, will reward the traders who maintain their discipline during the quiet periods. The VIX at 17.5, with the term structure in strong contango, tells us the market is in a healthy configuration. It does not tell us the market is immune to shocks. Nothing tells you that. What a strong contango term structure tells you is that the market is not currently bracing for an immediate shock, and that is a different thing entirely. So we go into next week with a clear picture. The S&P is at new record highs. The VIX is at 17.5. The term structure is in strong contango. The EDR has been generating consistent signals and consistent credit. The theta time shift mechanics are favorable, and the ALVH hedge is in place, quiet for now, but ready. That is a good position to be in, not a complacent position, a prepared one. There's a meaningful difference. And honestly, and I say this genuinely, this was one of the more interesting weeks we've had in a while, not because of drama or panic, not because of a crisis or a crash, but because of the clarity, the alignment, the way the signals across every asset class told the same story, and the way the VIXShield system read that story correctly and responded with 5 days of consistent, disciplined execution. That's what good weeks look like, not fireworks, consistency. If you're a new listener and this is your first time with VIXShield, thank you for spending your Saturday morning with us. What you've heard today is a representative sample of how we think about markets, through the lens of volatility, with a systematic approach to signal generation, and with an educational commitment to explaining not just what the signals say, but why they say it, and what it means for how you manage risk. We hope you'll come back next week. And if you're a long-time listener, thank you as always for your trust and your time. We'll be back Monday with the morning summary, and we'll be watching the week ahead with the same discipline and the same process that carried us through this one. If you found this summary valuable, consider upgrading to Pro or higher for the full twice daily VIXShield market summaries, proprietary signals, and private RSS feed. Visit VIXShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. This is VIX Shield, your protection against market uncertainty.